We're watching interest rates, and obviously the fear is our interest rates going to rise so quickly that either Canadians have trouble coping or that financial markets have trouble coping, because sharply rising interest rates are usually bad for the stock market. In this case, we're pretty comforted by the fact that we have a governor at the central bank in Canada who understands the risks associated with a very indebted household sector. The plan seems to be to raise interest rates slowly, so we might get a quarter-point hike in the next couple of months. I would suspect that we're going to sit another 6 months after that before we see a follow-up move. So a gentle hand at the Bank of Canada is quite reassuring right now. We could see the Canadian dollar a shade weaker, a cent or two weaker. Relative to the US, we're raising interest rates more slowly. That tends to attract a flow into the higher interest rate currency, which will be the US dollar. And for the Canadian economy, that's not a bad thing right now. Our exports haven't been growing that quickly. We might use the help of a slightly weaker exchange rate to give us that slight competitive edge. Typically, higher oil prices are a friend to the Canadian economy because we all pay a little more at the gas pumps. That drains consumer spending, but we usually see a bigger gain from the oil and gas sector spending a lot more on new developments, new projects. Unfortunately, right now, the oil and gas sector is facing weak natural gas prices and is a bit concerned still about whether there's enough pipeline access down the road to expand in Canada. So unfortunately, we're getting the hit to consumers a bit right now, and perhaps not the follow through, at least not this year, on the energy sector capital plans. We're watching the Iran situation very closely, of course, but it's more than Iran. It's a disruption in Venezuela that's also helped lift prices this year, and that's a more lasting story. We've certainly been riding at the back of the bus in terms of the Canadian market versus the US market over the last year or year and a half. The higher energy prices might help a bit. The financial sector looks a bit undervalued in Canada. But I think the bigger concern for financial markets generally is not 2018, it's what's the follow-up story in 2019. We're getting a lot of juice to the North American economy from US tax cuts. That's a this year story. And I think the reason we're seeing this volatility and why it might continue is it's not clear that 2019, with higher interest rates and no fresh tax cuts, is going to be as good a year for corporate profits. We always are reminded to tell investors that a diversified portfolio is a much safer portfolio. And in these sorts of situations where we've got issues with Iran, we've got issues on trade with the US, we have interest rates on the move, that's amplifying the uncertainty and certainly raising the value of having a well-diversified portfolio with not only exposure to different equity markets, but also some fixed income holdings as well, just for safety.